Victor. That's really great. So we're now recording, and I've explained under housekeeping to Victor that he can speak and present. And if you want to raise a question or ask, make a statement or challenge Victor, then please raise a hand. We'll also open up the chat as well. So if you want to make any comments in the chat, please do. But obviously, Henry and I like to interact and bring people in. So Victor, over to you for an introduction. If you want a short introduction of who you are for our members, but I'll leave you to now present, and over to you.
Okay, terrific. Well, hello everybody. So I'll give you a little bit of background and then jump right in. So my career, or I guess my relevant background is I went to the London School of Economics, and from there started to work at Salomon Brothers in New York. Then came back to London after about 10 years. I was in the fixed income area at Salomon Brothers in research and then in trading. And then I came back to London and opened the office for long-term capital management, the rather infamous hedge fund that failed in 1998. And after that, I left the world of hedge funds after that 5-year or so stint in hedge fund land. Took about 10 years to sort of figure out what to do next. Spent some of that time teaching actually at the LSE in the financial markets group. And then about 12 years ago, started a wealth advisory practice called Elm Wealth, which tries to help people make better financial decisions with their savings. I moved back to the States around the time of COVID. Here.
Oh, we've got Victor's frozen. Victor's frozen a little bit, but sorry, Victor, yeah, go on.
Pardon?
You froze for a second.
Is there feedback, or is that coming through okay?
No, you froze for a second. That's all. That's fine.
Oh. Okay. You know that the experiences that I had at Salomon, at LTCM, and then being in this wealth advisory field, and the wealth advisory work that I did really came out of this realization that once I left the profession, once I left the finance industry in 1999, I just didn't really know what to do, what was a good approach to take with my own savings, with my own family's savings. I just hadn't thought about it in the 20 years or so that I had worked in finance. And, and as I thought about all of this, I realized, in speaking with other people, that they also didn't have really great ideas for, really sensible and coherent ideas for how to manage their own savings. A few kind of experiments and research that we did really led me and my partner at Elm, James White. We realized that there just wasn't enough discussion of, how to incorporate risk into financial decisions, that especially in the personal finance or household finance literature, everything was focused on the question of what to buy, what to invest in, what's going up, what's going to go down, what are good investments, and very little was put onto the equally important question of how much should I invest in those things, how much should I spend, how much should I rebalance my portfolio, sometimes pay tax in order to get a better risk profile in my portfolio. And so we decided to write a book. The title of it is The Missing Billionaires, A Guide to Better Financial Decisions, which is really devoted to this how much question. And maybe just to start thinking about the question and how it's some and how difficult it can be in some ways, or how ill prepared I think so many people are, or myself included, before spending a lot of time thinking about this. We ran an experiment about 8 years ago where we got some young finance people together. We gave them $25 each, and we let them bet any amount that they wanted of their bankroll, starting at $25 on a coin, on a digital coin that we programmed to have a 60% chance of landing on heads. And we told them that we would pay them however much money they had left, or they had grown it into, after 30 minutes. Now, in 30 minutes, you could flip this coin 200 to 300 times if whatever strategy you had. And it turns out that following a simple, sensible betting strategy, that you should be able to. We put a cap on how much we would pay people of $250. We didn't want this to be too expensive of a behavioral economic experiment. And it turns out that a number of pretty simple betting strategies should give you like a 95% chance of reaching that $250. But our subjects, all of whom were very well trained in financial modeling and financial ideas and so on, and some of them were working as analysts in the industry, that hardly any of them, only 20% of them, reached that $250 cap. 90% of them should have, and 30% of them went bust. 35, 40% altogether lost money. And the average payout was, about $80. And when we looked at how they were betting, what we realized is that nobody came, nobody, we had about 65 subjects play the game. And virtually no one had a coherent strategy for betting on a biased coin. And we kind of thought, wow, that's strange. And again, we sort of reflected on our own experiences and said, well, if we had just been given this game when we were 25 years old to play, we wouldn't have had any framework either. That, in my education at the London School of Economics, that there was no discussion of how much should you bet on a favorable opportunity. And we went and took a look at the syllabi of these different graduate finance programs that these people had been in. And indeed, if you look at most, graduate finance programs and MBA programs, that in the finance areas of those programs, they don't talk about things like the Kelly criteria, which was a simple betting framework developed by Bell Labs' John Kelly in the 1950s for bet sizing in a gambling context. And they didn't study these breakthrough ideas that came out of MIT in the late 1960s by Bob Merton and Paul Samuelson on investment sizing in the context of a favorable opportunity. So, what would a sensible strategy look like for betting on a biased coin? Well, something like just saying, I'm going to keep on betting 10% or 15 or 20% of my bankroll each time on this coin. The coin had a 60% chance of landing on heads. Something like that would have been pretty sensible and would have given you this 95% chance of reaching the cap. What people did is some people bet a constant dollar amount. Some people doubled down. Some people just thought that, some people sort of were subject to this illusion of control bias, where after a few heads, they thought tails was going to be more likely and things like that. So, bringing this into the context of investing, how should we size our bets? Well, clearly the more attractive they are, the higher the return is, for a given amount of risk. We should want to invest more in them. And the riskier they are, we should want to invest less in them. And this kind of formulaic relationship between risk and return was put forward in this 1969 paper by Bob Merton and in a companion paper by Paul Samuelson. And the formula that they came to for sizing for how much you should expose to an attractive opportunity is known as the Merton share. And maybe this is a good time to share my screen a little bit. Let's see, share. Is that working? Just share the whole screen, I hope. Okay, I hope that worked. And so now, can people see this, my screen, I guess, right? Okay.
Yep.
So
Yep.
this is what the Merton share looks like, really simple, kappa hat, the optimal amount to invest in, let's think we're in a world of one risky asset, let's call it equities, global equities, and one safe asset, maybe that's, depending on your, depending on what your liabilities are and what your objectives are, that could be long-term inflation protected bonds, or it could be cash or bills. So the formula is that the optimal amount to invest is equal to your expected return on this risky asset relative to the safe asset, mu, and then divided by sigma squared, where sigma is the riskiness of that investment expressed as a standard deviation of returns, and gamma is this personal or institutional degree of risk aversion, which normally for most people, and we can talk about this maybe in the questions part or the discussion part, that number is normally between 2 and 3. And you can kind of see where we get to that from in the chart below it, where we say, okay, how much would you want to have invested in equities versus a safe asset based upon these three different parameters or inputs. So on the x-axis is how risky the investment is. On the y-axis is how attractive it is, the expected return. And then, showing you for three different levels of risk aversion, how much, well, actually we're showing you for those three different levels of risk aversion, what combination of return and risk would lead you to want to have 60% in stocks and 40% in bonds. So you can see this trade-off. It's not linear. Because in the denominator of the Merton share, we have the variance or sigma squared, or the riskiness of stocks squared, it kind of makes sense, right? I think it makes sense to people. It seems intuitive to think that, okay, if I have this risk aversion of 2 and an expected return of around 4%, and the stock market has about 20% risk, then I'd want to have 60% in stocks and 40% in bonds. So that's the Merton share. And again, we can talk about that more. I want to try to cover, a good amount of ground here. So, I think that it just makes a lot of intuitive sense that that the more attractive your investment is, the more attractive the opportunity set, the more you'd want to invest in it. And this brings us to the question of, well, then, why is it that why wouldn't we want to have a dynamic asset allocation if we believe that the expected return on stocks relative to safe assets changes over time, and that the riskiness of the stock market changes over time, and that we can observe these two, and we can observe the expected return and riskiness of the stock market. That why wouldn't we want to be changing our asset allocation over time? Of course, if we don't think that we can estimate those things, then we would probably ask ourselves, why do we even want? How can we justify investing if we can't estimate them? Or if the only estimate that we have is historical returns, I guess you could say, okay, well, the only input that I have, or the only estimate I have for the expected return of the stock market is historical returns. But we can see that the safe asset return is moving around, whether the safe asset is short-term or long-term fixed income instruments. We can see that those returns, the yield on those instruments is moving around So we'd have to believe that somehow the stock market is exactly moving around, the expected return of the stock market is moving around exactly in a way that keeps the excess expected return constant. And anyway, our belief is that both the expected return relative to the safe asset and the risk of the stock market can be estimated at any point in time on a prospective basis, and that they change and move over time, and hence call for a dynamic asset allocation. So let's just take a quick look at that. The first thing is that a lot of, one simple metric for thinking about the expected real return of the stock market is that it is that a reasonable estimate of that is the cyclically adjusted earnings yield of the stock market. And so this is for the US stock market, and on the x-axis, what we're looking at is the earnings yield, the cyclically adjusted earnings yield at the start of a period. This is going back to 1900. And then we look at the next 10 years of real return of the stock market, which is on the y-axis. And you can see, that this is doing a lot of averaging within each bucket, but you can see that in general, we could have done a scatter plot to get to the same sort of implication, that the lower the earnings yield is, the lower the next 10 years of return on average have been, and that goes up, and it goes up in a fairly linear fashion. It's not exactly linear, but close to it. And you can see that actually, that the real return over the next 10 years on average has been about the average earnings yield at the start of the period. So that's one thing that we can look at. And then we could also come to an estimate of riskiness of the stock market in all different ways. We could look at recent realized, we could look at some averaging of recent and longer term volatility of the stock market. More recently, with the development of the options market, we could also blend in some information from medium term implied volatility of options. I think that it just is, it's pretty clear that at times like early 2020, that the stock market is just a lot riskier than at other times. There's a lot more uncertainty. Where are we going? How bad is this pandemic going to be? How much damage are we going to have to our economy, our financial system? And things just feel a lot riskier. I think that people have a good sense for when the stock market is in a much riskier phase versus times when things are sort of quieter and more benign in terms of volatility. So putting these two things together for the U.S. stock market and using long-term U.S. TIPS as the safe asset, this would be the allocation to U.S. equities based on the Merton share since 1998, when the U.S. started to issue index-linked, inflation-protected securities. So the two things here are that we don't allow shorting and we don't allow leverage either. So you can see that at one point in 2012, we hit 100%, and we just capped it there. And in the early period, TIPS were so attractive that their yield was actually higher than the earnings yield on U.S. equities. And so the Merton share called for no investment in U.S. equities from 1998 until about 2002. So this is the allocation that we would have come to just using the Merton share based upon earnings yield. So how would that have performed? And again, this is not like in doing this, we're not using any sort of historical average return or average PE or anything like that. We're just saying, here's a person who has a certain risk level, a certain coefficient of risk aversion, and they're just scaling their exposure to the stock market based on how attractive it is relative to the safe asset over time and changing it. Well, that did pretty well. The dynamic strategy there outperformed both in terms of return, but more importantly, it outperformed in terms of the quality of return. The Sharpe ratio was 46% higher at 0.78 versus 0.54 for a static exposure that had the same average exposure over that period, or roughly the same average exposure over that period. Now, that's, you know, that 25 years or so of a historical look just isn't a lot of data. It doesn't really prove anything. In fact, we just don't have enough data. Even going back further, we don't really have enough data to conclusively decide that this is a better way to invest. I think that what I would propose is that it just is a more sensible way to invest. So here, what we did is we said, okay, well, let's try to bring this back further, even though we didn't have a tips market. That we said, let's try to imagine where tips might have been trading going all the way back to 1900. And actually, from going earlier, from 1998, we can use the index-linked gilt market to give us some indication of what real rates might have been in the US as well. And then we can bring the analysis and take it further back to 1900. And taking it further back to 1900, we get the same kind of picture of the dynamic strategy giving a higher, producing a higher Sharpe ratio, a higher return, and just seeming to be more attractive. And again, this is only based on U.S. equities. If we broaden this out to look at global equities, including UK, European, Japanese, etc., the results look better because there's more. There are more things to invest in that at different times have had different amounts of expected returns relative to the safe asset. And we wrote about this in an article that was published in the Journal of Portfolio Management about 5 years ago, and we laid this out in somewhat more detail than here. So anyway, let me stop there. In terms of let me stop there in terms of this dynamic versus static asset allocation, and I think that maybe just a few words on the book and the title of the book. I'm going to stop sharing here, I think. We can come back to that later. Okay. There we go. Can everybody still hear me? I see.
Yeah, that's good, Victor. Yeah, we've got a few questions. Paul or Derek have been putting questions in the chat.
Okay.
So, Paul, do you want to go first?
Yeah, let me stop there. I mean, that's been almost
just have a quick question.
Yeah.
Have a break. Have a question.
Yep,
take stock.
great.
Take stock. Hey, cool. Paul, go on. You go first with your question, then we'll come to Derek. Yeah, go on.
Yeah, thanks. Fascinating backstory as well, Victor. I've just pulled up your TED talk. I shall have a look at that later as well. So, yeah, I mean, well, a quick question is where does that Merton percentage sit right now, given that we've had such a jump in long-term bond yields? Fascinating to see that it sat at zero in the late 90s. I'm sure you're familiar with the story of Tony Dye in the UK, who was the fund manager of the largest pension fund in the UK at the time, and he got sacked for pulling money out of equities in the late 1990s and from Phillips and Drew. And Phillips and Drew pension funds actually went through that period perfectly smoothly because of his work, but he got sacked because they were falling towards the bottom of the tables. I think Jeremy Grantham's got similar stories about losing money from his portfolios at the same time. But yeah, I mean, that aside, where's the percentage now?
So for U.S. equities, as you point out, well, I mean, that first of all, the change that we've had in the last 18 months is really dramatic, with depending on, again, what you use as your safe asset, but almost anything that you're using as your safe asset just has a much higher expected return than it did 18 months ago. And again, we think that for long-term investors, the the best safe asset to the most appropriate safe asset is long-term index-linked bonds, which have gone from, say, -1 or 1.5% to +2.5% over a period of time when equity markets haven't done that much. In our view, the expected return of equities relative to safe assets has compressed dramatically over the last 18 months. And in the U.S., we see that that risk premium, as under 2%, maybe around 1.5%, very unattractive, not very attractive at all. And in the rest of the world, the risk premium is much higher. Taking all the rest of the world as one, that risk premium is closer to between 4 and 5%. So we put them together, and the risk premium is maybe 3.5% or 3% on a global basis. And so, we think that long-term investors should have more in safe assets and less in the risky asset than has been the case in a long time. So somebody that, I think a good way to sort of think about it is to say, well, if the riskiness of the markets is kind of at a normal level, and the expected return of stocks relative to safe assets is say around 4%, how much equities would you like to have in that circumstance? And that's really a good way of calibrating that gamma risk aversion coefficient. And if your answer to that is, well, I'd like to have around 60 to 70% in equities versus fixed income at that time, we're quite a bit lower than that. So somebody that was saying 60 to 70% at 4%, should be, maybe around 50% in equities, or 40 to 50% in equities now, with the risk premium so much tighter and so much higher yields being offered on inflation protected bonds. By the way, I knew Tony Dye, or I know Tony Dye. I was good friends with Bryce Cottrell, who was the last CEO or managing partner at Phillips and Drew, and he introduced me to Tony Dye back at that period of time as well. So yeah, that's a great example to think of there.
He's gone sadly now, because he got fired. He set up Dye Asset Management, and he's been gone a few years. But I wrote a piece in my blog about that story, because I think for the UK market anyway, that story is what's the word? It's the background to how all fund managers are inclined to take more risk than they need to. Because basically you get sacked if you don't. What is it Chuck Prince said? Whilst the music's playing, you got to keep dancing.
Yeah.
Thank you.
Again, I think that our book, one of the things that we keep coming back to in our book is that what we want to do is try to help people to think about how to make good financial decisions, and that so much of what we read about these days is like, what are the different, behavioral foibles that we have, and how do we make these suboptimal decisions? And they kind of, like so much of the financial literature that I read, sort of takes this position of, okay, we're just destined to not make good decisions, so let's just accept that and do the best that we can. And the whole sort of the criticism of using expected utility to make good financial decisions, which is at the core of our book, is that, that doesn't really describe how people make decisions. And we say, well, no, we're not. Our book is not trying to describe how people make decisions. We're trying to describe what would be a sensible way to do it. What's a better way to make decisions? And sometimes the institutional constraints are just too powerful, and we have to be cognizant of that. But when it comes to individuals managing their own savings, we have freedom. Each one of us has freedom to try to make good decisions. There is no institutional imperative on us.
Sorry, just to round off on that. I mean, I think there's two conflicting narratives going on here. I think you're absolutely right that there's one question about whether dynamic asset allocation is a good idea, And then there's another question about, well, there's a number of things. There's another question about capacity for risk, per life goal, into the personal financial planning realm. And then there's behavioral stuff. What concerns me, I'll be upfront about it, what concerns me in the financial planning industry is a small proportion of people, I think they are, I hope they are a small proportion of people, who ignore valuations altogether and say it's all about your behavior and we've got to manage your behavior to keep you fully invested at all times. That's the bit that worries me, is that they're not taking account of your narrative at all.
Yeah, agreed.
Thank you.
Thanks for your question, Paul. Derek, Scott, you've put a couple of notes in chat. Do you want to go next, and then we'll come on to Peter Cameron Brown.
Okay, I'll try. Victor, somebody else that you knew obviously is Robert Merton. You were both in LTCM together. I find it interesting, the timing of Merton's paper on the dividend share, given he had clearly not done so well with LTCM. I mean, he was one of 16 partners. You've admitted in an interview, I think, that you, with hindsight, foolishly invested 80% of your liquid capital in LTCM. Did Merton over allocate as well, to the best of your knowledge?
Yeah, I mean, I think that it's hard to say. In Bob's case, I don't know exactly. We didn't. The partners didn't know exactly each person's personal financial situation. I'd say that the partners in general, that we tended to have overinvested, that we tended to not. I wasn't aware of any of the partners using an expected utility framework to sort of think about the sizing of how much to have there. And, in chapter 8 of our book, we talk about how one could have applied an expected utility framework to that decision of how much skin to have in our own game. I think that is the more interesting lesson and question from LTCM. The fact that the investments that we made didn't work out, or that we had them sized too big. I don't think that. I mean, that's just part of investing. That you make money, you lose money. That was interesting. How things went wrong, but to me anyway, the most interesting lesson of value from LTCM was, how did the partners, or how did I, in particular is what I can talk about, and which I talk about in the book, how did I make my decisions, and what can be learned from that? And I think that, I did not have a coherent framework to use at that time for how to size, what to do with my own personal savings. And I overinvested in LTCM. Obviously I overinvested given what happened, but the argument that I try to make in the book is that sitting there with the information that I had before LTCM went down, I had enough information there to know that the right decision would have been to be less invested in our fund, and to have had more investments, and to be more diversified.
Okay, I did check on Robert Merton's net worth. It's reported as being 12 million. So he's a millionaire, but he's not a billionaire. My other comment was really, you've talked about a safe asset in the US context, and you've in answering Paul's question, you've indicated that this is quite a good time to consider that asset class. Unfortunately, the UK equivalent of index-linked gilts has performed very badly over the last 5 years. So I appreciate with hindsight, you're saying, well, you shouldn't have had very much in it relative to equities if we had done your decision-making format. But it is hard to sort of think of this as a safe asset when it loses 7% per annum over 5 years, and hasn't really beaten inflation over 20 years. So it's not generating a real return, which is not what you expect from a safe asset.
Well, I think there's two things. There's sort of two things there. One is that the best safe asset to use in thinking about the risk of different investments. And I think that for long-term investors, that is the sensible choice of safe asset to use to think about the riskiness of all other assets. Now, when index-linked gilts were trading at -2%, for a prolonged period of time, the other assets that one could have invested in are, let's say, equities, and also you could have invested in a shorter term fixed income. And shorter term fixed income, I think would have looked more attractive than it does today. And so, in doing that whole allocation, the result might have been to not have had much of index-linked bonds, to have had a lot more of equities, and maybe most of the rest of it in short-term fixed income. So, I agree with you that we went through this period of very low and negative real rates on the safe asset, but we could still have arrived, using a sensible, coherent framework, we still could have arrived at an asset allocation that would have made sense, even though this safe asset was so obviously unattractive. I mean, the idea of buying 50-year index-linked bonds at minus 1.5%, that there's no reason that you have to do that if that's the only asset that you have to invest in, sure, you have to buy it. That's the only thing you have. You have to put your money, there's no alternative. But there are these other alternatives, and I think that working through their expected returns and riskiness would have led to a very small or zero allocation to these long-term index-linked bonds, even for people that had that very, very long-term set of liabilities.
Cheers, Victor. Thanks for that. Peter Cameron Brown, you've got a query, I think, regarding compounding, or?
Yes, yes. Partly my point has been picked up by Derek, perhaps because of our very similar backgrounds. But my point was, you talked about the performance of equities being over the following 10 years being very much linked to the initial yield at the start of the period on equities, and I was just speculating that probably the reason for that is that the dividends are being reinvested in the measure that you're using for that. So if you have a dividend yield of say 3%, that's 3% is assumed to be reinvested in the index, and therefore that measure. And I was comparing that.
Yeah. Mm-hmm.
And then I was comparing that to the index-linked gilts, which have a coupon rate of interest in the UK for most of the current issues of 1/8 of 1%. So the actual year-on-year income from the gilts is virtually zero. So you're entirely dependent on the ultimate value, the redemption value of the gilt at maturity. So I think that's a different comparison, and I should say that we've adopted in the DB pension scheme, we've adopted what we called a dynamic investment strategy since 2005, but we've put just the new contributions into the asset classification that's been sort of targeted, if you like, on that basis, so that we should be increasing our allocation to and left the existing assets in place. We think that's achieved an excess return of 1% over the sort of target base return of, say, a 60-40 split. But yes, I'd be interested in your comments, and it was really the point picked up by Derek about the UK index-linked gilts being sort of having this different characteristic from one that's giving an index-related return. The other thing perhaps I should add is at the moment our strategy is pointing us to put more money into index-linked gilts, which is probably a point picked up by somebody else in the chat.
Yeah, no, I think that makes sense, relative to say 18 months ago. Indeed, all of the numbers that we are looking at are total returns, and well, mostly we're focused on real returns, real total returns, indeed. So, dividends being reinvested and then being adjusted for inflation in terms of how they're presented. The one thing that I should that I should just emphasize is that that over a 10-year period, the cyclically adjusted earnings yield of a broad equity market is a a decent estimate of the next 10-year real return, but it's not a very good estimate. I mean, there's a tremendous amount of volatility around the 10-year return. It just is that it seems to be a decent estimate of it. And we think that kind of makes logical sense, but it's not a very good estimate of it. It's not like the outcome. It's not like the next 10 years of return is going to track the earnings yield at the beginning very well. There's going to be some 10-year periods where the return was much higher, and others where it's much lower. But on average, we think that it's a decent, useful estimate.
Thank you.
Okay, great. Going back to the chat, I think we have another question raised by Chris Evans. Chris, you're talking about the S&P 500.
Yeah, thanks. And Victor, really interesting conversation. Just really wanted to understand, the extent to which you've sort of looked or thought about, the increasing concentration that you're seeing in the S&P 500 and the, impact that potentially has, on a forward-looking basis compared with a more diverse index. I mean, I know this year, for instance, that I think the Magnificent Seven have averaged a 90% return. They've contributed 3/4 of the overall return of the S&P 500. Just wondered what this strategy would look like if you had some form of sort of capped index, or whether or not you think the strategy becomes more or less valid when you've got this high level of concentration.
Well, I think that the strategy or using earnings yield as an estimate of the expected real return of equities, I don't think that that's very useful, to be applied when you're applying it to a small set of stocks or, individual stocks, a small segment of stocks, a sector of the stock market, or even a very small stock market. I don't think that it's very powerful if you're just applying it to the Swiss stock market, for instance. But it is I think that it is a decent estimate when you're applying it to the whole US market, the whole European market, or the whole emerging markets, all together as well. The concentration, I mean, the concentration in the US has gone up. We don't think that when we look on a global basis, we don't think that those individual stocks are at a level of concentration that really makes us worry about the earnings yield being a decent estimate of the future real return of the US stock market, or applied in a more global setting. We don't think that concentration is has reached a level that we're concerned that earnings yield is no longer a good estimate. There probably is some. I think that if we woke up and 3 stocks represented 80% of the stock market, or maybe well before that, we would be really worried about that. I think Japan in the late 80s is kind of a good case study, in terms of using market cap indices blindly, just feeling, the incorrect thing to do. I mean, Japanese equities, I think, represented maybe 45% of global market cap in the late 80s. And, I think that in terms of a global market portfolio, having something there that weighs against that, would make sense, whether it's capping it or whether it's using some other metrics to do an adjusted market cap, that would be more sensible. And indeed, the index providers, MSCI and FTSE, do make adjustments, very dramatic adjustments to market cap, just based on other factors such as investability and openness of the markets. So, I think those are things to be concerned about. Right now, I'm not that concerned about, personally, I'm not that concerned about the size of the Magnificent Seven in the US stock market, and particularly on a global basis. We wrote about it. We wrote an article about it. It's on our blog, sort of discussing the question of, okay, one way to think about is how concentrated the US market is to say, well, how much extra return do those stocks need to offer to warrant their market cap place in the U.S. index. And the answer is not very much, and not an amount, something in the order of tens of basis points of extra return because they're so large. And that's a small enough amount of return that it's just not discernible, to say, well, no, we shouldn't want to own the market cap amount of that because their expected return is clearly less, is not giving us an extra 10 basis points versus the market return. So it's something to be worried about, but I'm not particularly worried about it right now. And it's not, by the way, I don't think that it's not completely unprecedented historically either. I think that we have had periods of time of concentration in names greater than this, and it is pretty typical for a small number of stocks to represent a lot of the market gain over a period of time.
Thank you. It was just interesting because also I think you'd mentioned, the forward-looking earnings yield on the US was lower than in other markets. So I just wondered the extent to which that was because of the impact of those stocks as well. Yeah,
it's much broader than that. That low earnings yield relative to that every single sector in the US is trading at a higher multiple, a lower earnings yield than the same sector outside of the US. Like I think it's almost every single sector is like that. So this sort of premium valuation or lower expected return or greater belief in US growth, is really pervasive across all sectors of US stocks. I think that could have been a really good topic for a whole session. Is just US versus non-US equities is fascinating right now.
Thank you.
Cheers, Victor. Okay, we've got a hand raised by Paul. Do you want to ask your question, Paul, or make your point?
Yeah, no, it's a question. So we've had some chat in the chat, funnily enough, about demand and supply for fixed interest, maybe potentially distorting the markets. I mean, fixed interest stuff and tips is dominated by pension funds here at the moment, unless we can persuade retail investors to buy more of the things. But the other big distorter, and I just wonder, which is global, of course, and I just wondered what your view on this is: central banks buying bonds for the last 15 years, taking yields down to nothing or minus. We haven't had free markets for 14 years, have we? Are we moving to a period where we might be able to describe them as moderately free going forward?
It certainly. I mean, I agree with you, and it feels like we're moving into a period where there's going to be less distortions from central bank interventions in the marketplace. Yeah, I mean, in some ways, I think that I personally am more a believer that the central banks are really affecting interest rates. There's a lot of central bankers say, no, we're not really. We're just sort of smoothing things. We're not having an impact on interest rates. And I don't subscribe to that myself. I feel that they have a tremendous impact on interest rates, both at the short end and the longer end too. With their policies, even when they're not intervening in the longer term fixed income markets, I think they're having a huge impact on how people see and perceive longer term interest rates. So I hope that we're going into a more normal period where fixed income is giving us real signals about supply and demand of real investors, and not being bullied by massive central bank intervention.
Thanks for the question, Paul. Simon Glover, you've talking about dynamic strategy. Do you want to just, Simon, do you want to ask Victor and make your point?
Yeah, this might be slightly unfair for Victor because he's not based here in the UK per se, but in proposing a dynamic asset allocation strategy, great idea, and we manage one, but it's almost impossible to obtain a risk rating because you can be potentially, 100% equity exposure or 0% equity exposure, and IFAs can't match that to their clients' attitude to risk, because 1 month it may be all equities, next month it's nothing. So unfortunately, practically, commercially, dynamic asset allocation, I don't see how it works in the UK under our current regime.
Yeah, well, I think that if we look at in the US as well, dynamic asset allocation is just a tiny part, of the overall asset allocation offerings to both institutional and individual investors. So, I think that not only are there regulatory issues that weigh against using a dynamic asset allocation, but it just isn't that the benefits of a dynamic asset allocation are while we think they make an awful lot of sense, at the end of the day, it's not like some sort of alpha that you can definitely count on, over any short period of time. So, for a variety of reasons, I think that the adoption of dynamic asset allocation by large parts of the investing community is something that's probably never going to happen. But we think it makes sense for people, in cases where they do have that flexibility, in making their in designing their own approach to investing. So, we have 400 or so clients, about $1.5 billion, all told, and that's about 65% US based and 35% non-US investors. But even though we think it makes a lot of sense, even though we charge a very low fee of just 12 basis points, there's not a massive amount of take up in this approach to investing. So I agree with you, Simon, and it sounds that the environment in the UK is even tougher to get people to adopt this. Although, again, well, there's large segments of investors that do have freedom in terms of how they invest and aren't are not subject to these regulatory constraints.
Thanks, Victor. Yeah, that's good. Paul, you've just put another point in the chat regarding defining risk as a percentage of exposure to equities is a curious idea. Do you want to just make your point, Paul?
Well, I don't want to hog the microphone, Steve.
But, well, I like your microphone. It's very red. I love your red microphone.
Well, no, I'm just making the point, building on the previous questioner, that, we do have this curious idea, don't we, in the UK, that we define risk bands as being your percentage to equity exposure. And that simply doesn't work at times of high or low valuations, does it? I mean, if you take 1980 or whenever it was in the US, then equities were on the floor, but you'd have still said people were taking a high risk to put much money into them. So it's just a crazy system that we've got that suits the regulator. It doesn't make any sense at all. And what's more, my point is that this varies across the UK. I've said that a good friend of mine who's one of the leading financial planners in the UK has pointed out that a medium risk client is defined as having 80% in equities if he lives in London, but only 30% in equities if he lives in West Wales. And I spoke to him the other day, actually, and he said it's still true today. So, I don't know. I think we need to sort ourselves out a bit, don't we?
That's remarkable. Yeah, that's remarkable.
Do you see that in the States, Victor, or is the observed risk different from location to location? I.e., are Californians, defined as 30%, and East Coast people defined as 80%, a bit like the London and Wales analogy? Does that happen in America, or is it much more rigid?
Yeah, not that I'm aware of, but it'd be interesting to that's a really interesting thing to explore somewhat. Maybe I don't know, maybe in the middle of America, maybe there's a coastal versus central difference. I'm not sure. But
Yeah.
there is much more. There's much more integration. I mean, there's a lot of integration among financial planners in the U.S. where, or there's, I don't know, there's a fair amount anyway of integration of national financial planning brands. You know, especially the financial planning that comes out of, say, Fidelity or Schwab. You know, is really broadly national in nature.
Yeah. Wow. Okay, Stephen Glover, you got your hand up. Do you want to ask a question?
Yeah, I just want. Can you hear me?
Yes, we can.
Yeah, okay. No, I just wanted to add to that, and also I apologise. I've had to sort of drop in and out of the call, so I haven't heard everything that Victor has said, but I found it very interesting. I caught some of the graphs at the beginning, and to me, what struck me was, you know, those graphs and that type of analysis is second nature to me. I did a lot of work on asset allocation at the outset of my career a long time ago, applying these kind of ideas to investing in the UK. But just picking up on the last point that was made, that Paul made about risk and so on, you know, I think the difference over here is, you know, is far more basic. Your analysis, your thinking, your approach to asset allocation is based upon some basic premises and assumptions. One of them, of course, is that there exists an equity risk premium. You know, asset allocation studies in the US going back to 1919, you know, demonstrate very clearly that, you know, stocks have outperformed bonds over time and bonds have outperformed cash, etc., etc. Even accounting for periods of severe downturn like the Great Depression and the markets crash in the late 80s, etc., and indeed the financial markets crisis. There's a lot of people over here who don't believe in who don't support the idea of an equity risk premium. So therefore, this whole asset allocation methodology is much less accepted over here, but by many, especially people who've been in the DB pensions world, who've bought into this, you know, de-risking approach over the last over the last couple of decades. And the other thing is, I think, just to go back to Paul's point, I think there's a fundamental mismatch between how people think of risk in certain ways. I mean, over here, certainly in DB land, which is, I think, mainly where Paul was coming from, you know, to say any addition to equities is a risk, you know, is defining risk as purely downside risk, not the risk the way investors think of risk, which is volatility, and therefore therefore there's a risk of outperforming as much as there is a risk of underperforming. It's not a one-way street, and so on. So this is a bit of a ramble, but I put it to you that a lot of them, not everybody, a lot of the mentality, a lot of the attitude to this is meaningfully different over here than in the US and other places. So I wonder what you would say to those particular sort of non-adherents or skeptics when you are talking about these issues.
Well, I think the question of equity risk premium, there's sort of all this historical work that people have done looking at the historical returns. But you know, I think that what's more powerful is, you know, to sit at any point in time and to look at the prospective real return of equities, that we can see, you know, we can buy equities just as we can buy a building that has tenants in it and is paying us rent. You know, when we buy these companies, they have earnings, and we can see, you know, how much earnings are we buying for £1 of investment. And you know, I think that this logical framework of just saying, well, whatever, let me just assume that earnings yield can just keep up, the earnings of these companies could keep up with inflation, even if they paid out all of the earnings as dividends, which they don't do. So they retain earnings, and then they're able to grow earnings faster than inflation. But if they, you know, that at least if we believe that that earnings stream would be sustainable in real terms with a full payout of earnings and no retained earnings, well, then that's giving us this long-term expected return of equities that's not dependent on any view of how the valuation of that equity market is going to change over time. So we can just say, well, if I just hold these equities for a very, very long time, and if I, under this assumption, that's what my return is going to be, and then we can just say, okay, well, that's the hard part. The easy part is comparing it to some safe asset. If that safe asset, I'd like to find a safe asset that also has a long-term real return. And so that's why the natural thing to look to for the safe asset by comparison is long-term inflation protected bonds that are giving us a real rate of return that's just equal to their yield. And so we can see what that risk premium is the equity risk premium is at any point in time. And and in fact, I think there were historical periods where the bonds, what's offered by those bonds versus what's offered by stocks was very close to zero or even at zero. So there have been times, I think around the year 2000, we would have said there's almost no equity risk premium at all. But that's what I would say is just is to look prospectively, and I don't know any other way to discuss it other than to think about it logically and prospectively in that way, to have that discussion around that, framework, because I think that whatever has happened historically, that history doesn't necessarily mean that we're going to see the same thing in the future. And so I think that anybody who says, well, that's just history, I'm going to dismiss that, I think that they have there's a certain validity to that argument. And I have a sympathy for that argument. If somebody says, okay, you can show me that the last 100 years equities have outperformed bonds, that doesn't mean that there's an equity risk premium going forward. I'm actually sympathetic to, if somebody wants to argue that, I'm sympathetic to that. But then I would say, okay, I agree with you. The history doesn't count for that much. Let's look to the future. And that's how I would look to the future.
Fantastic answer, Victor.
Thank you.
Yeah, really good answer. Thank you very much. Well, we're out of time, Victor. Time for you to go back to bed and get some beauty sleep in Jackson Hole. From everybody here in the UK, I think fantastic presentation, great knowledge, great experience, and a very, very interesting subject. I mean, we could talk for days. Big claps from Paul. Look at that, Paul's clapping. We could talk for days on asset allocation and investments, and some really useful stuff.
Yeah, no, thank you, Stephen. There's so much more that I think could be interesting to your group that's in the book. I'm not trying to hawk the book or anything.
Yeah,
but really,
buy the book. Yeah.
But I do think, I mean, we have a whole segment that talks that brings spending and investing together, in this framework where risk is the central concern. And there's so much more that we could have talked about. I wish we had had more time.
Well, we'll do it again. We'll do it again next year, Victor. We'll do it again next year. We'll bring you back because you've got a lot to say and you've got a lot of knowledge, and so impressed. Absolutely fantastic. So that's great. So thank you for your time. I hope everybody enjoyed today. Next week, you might know him, Victor. We've got Professor Anup Basu next week on Pension Playpen, talking about DC and the Australians, innovation in pensions and what's going on in Australia. So if you fancy getting up again at 3:30 in the morning, Victor, join Professor Basu next week. So that'll be great fun. But no, listen, everybody, thanks for joining today. I hope you've enjoyed it. Let's pray for peace in the East and peace in the Middle East. There is a ceasefire at the moment, thank goodness. We wish everybody well for the rest of the day, rest of the week. Hope you enjoyed today's session. The video will be up on the website later on this afternoon. And Victor, thank you again. And please check out Victor's TED Talk. That sounds cool. I'm going to check out your TED Talk, Victor. So I'll be on TED Talks later today to see you in action and inspiring thousands, if not millions, I guess. So brilliant stuff. Thank you, Victor, and good luck with the book. And we'll check that out as well. Thanks for your time.
Awesome.
All right, cheers, everybody. Take care. Thanks a lot. Bye.